Good morning and welcome to our August general meeting. It's tricky. Are you in compliance with FASB's new lease accounting standard? I'm Brianna Wright, Executive Director of ASA Houston chapter. Right now, all participants are on mute. We'll hold answering questions until after the presentation. You can ask your questions using the chat feature or raise your hand at the end of the presentation and I can unmute you so you can ask your question. Today, we have three panelists to discuss the Financial Accounting Standards Board, or FASB's new lease accounting standard. To discuss the CPA side of the standard, we have Jeff Timmerman, Senior Audit Manager at Melton & Melton. Jeff graduated summa cum laude with a Bachelor of Business Administration in Accounting from the Seidman College of Business at Grand Valley State University in Grand Rapids, Michigan in December of 2006. He joined Melton & Melton immediately following graduation and was promoted to Senior Manager in July 2014. Jeff primarily serves clients operating in the construction and oil and gas industries. He is a member of ASA Houston chapter and the Houston Producers Forum, the American Institute of Certified Public Accountants, the Texas Society of Certified Public Accountants, and the Houston chapter of the Texas Society of Certified Public Accountants. Welcome, Jeff. To discuss the banking side, we have Amaris Dawson, Vice President, Commercial Relationship Manager on the Southwest Commercial Lending Team in the Regional Commercial Banking Division for Amegy Bank. The group targets C&I banking opportunities with companies ranging from 10 million to 500 million in revenue. Dawson joined Amegy Bank in 2014 and is a graduate of the Bank Officers Development Program. After the training program, she joined the Southwest Commercial Lending Team, where she has previously served as Commercial Associate and Portfolio Manager. Dawson received a bachelor's degree in Business Administration and Finance from Texas A&M University in December 2013. She is an active member of ASA Houston chapter and Amegy Bank's Women's Business Resource Group. She is a graduate of the Fort Bend Chamber of Commerce Leadership Forum and as well as Amegy Bank's Formal Mentoring Program. She has formerly served as the Candlelighters Young Professionals Group Committee and on Amegy Bank's Digital Signage Committee. Welcome, Amaris. And to cover the surety information, we have Toby Miclette, surety bond producer, Senior Vice President and shareholder at Bowen, Miclette and Britt Insurance Agency. Toby is responsible for managing the bond department with annual bond premiums in excess of 40 million. Toby began his career in the surety industry in 2003 as an underwriter with the Hartford and joined Bowen, Miclette and Britt in 2006. Toby is a former executive committee member for the National Association of Surety Bond Producers, a current director and executive officer for the Houston chapter of the Construction Financial Management Association, and actively participates on agent advisory boards for multiple surety companies. Bowen, Miclette and Britt Insurance Agency was founded in 1980 and is currently among the top 25 largest independently owned insurance agencies in the U.S. It is headquartered in Houston, Texas, with additional offices located in Arkansas, Louisiana, and Florida. And with that, I will turn it over to Jeff to start our presentation.
Thank you, Brianna. Next slide, please. So in 2016, the FASB issued the Accounting Standard Update 2016-02, which is implementing the new lease accounting standard. Go ahead and go to the next slide, please. And so the big question for everybody is, when does this go into effect for private companies? It's going into effect for years beginning on or after December 15th, 2021, which effectively means for most of you, that's going to be for the year starting January 1st, 2022. Next slide, please. One of the biggest things with the new lease accounting standard is that it changes the definition of a lease. A contract or an agreement meets the criteria to be classified as a lease if the contract explicitly or implicitly specifies the use of an identifiable asset, that the lessee controls the use of the asset for the period of the lease. And this is going to apply to all identifiable assets except for minerals, such as oil and gas, biological assets such as timber, assets that are under construction, intangible assets, and inventory. Next slide, please. So the first thing that a company is going to have to do under this new standard is read through their various agreements and determine, if there is a lease in those agreements. And so when you read through the agreement, you're going to need to identify any lease component, which will be the right to use the underlying asset. A good example would be if you have an agreement for internet services or cloud storage, and there's a right to use a specific, to store your information on a specific server. That could qualify as an underlying asset under the new standard. Then you're also going to identify the non-lease components, which are any goods or services that are provided to the lessee that are separate from the right to use the asset. Now you'll be able to make an accounting election to bundle any of the non-lease components with a related lease component by the class of the underlying asset, which would mean that instead of trying to determine, how much of the payment is related to the asset and how much is related to the other services, you could just go ahead and say that all of the payment is related to the leased asset. Next slide, please. Then the next step will be determining the term of the lease, and that's pretty straightforward. It'll be any of the non-cancelable period where the lessee has the right to use the underlying asset, and that could be adjusted for any of the lessee controlled options, such as extensions, renewal periods, or a right to terminate. And those would be included in the lease term if it's reasonably certain that the lessee will exercise that option. Less common, there may also be lessor controlled options, such as extensions, renewals, or terminations. And then you have to assume that any of the extensions or renewals will be exercised and any terminations will not be exercised. There's also an accounting election that you need to make upon implementation, where the company does not have to recognize lease assets and liabilities related to short-term leases. And under the new standard, a short-term lease is any lease with a lease term of 12 months or less. Next slide, please. The next step will be determining what are the payments that need to be made under the terms of the lease, and that'll be the sum of all the fixed payments, including any fixed amounts for property tax and insurance, any of the variable payments that are dependent on an index or a set rate. You'll discount for any incentives paid or payable to the lessee, and then there are also some examples of other additional payments, such as exercise price of a purchase option, any penalties that you determine will be likely to be paid for early termination, or certain amounts related to residual value guaranteed to the lessor. Next slide, please. The next thing that you'll need to determine is, what interest rate to use when determining the lease liability. It may be that the rate is explicit or implicit in the lease agreement, or it could be the company's incremental borrowing rate. Now, non-public companies have an election that they can just opt to use the risk-free discount rate for determining it, which will make the calculation simpler. Next slide, please. Once all that's been done, the company will need to determine whether the lease will be classified as an operating type lease or a finance type lease. There are 5 specific criteria relating to a finance type lease, and if the lease meets any one of these criteria, it'll be a finance lease. If ownership of the asset transfers to the lessee at the end of the lease term, if the lease includes a bargain purchase option or other type of purchase option that the lessee is reasonably certain to exercise, If the lease term is for the major part of the asset's remaining economic life, that'll have to be based on, that'll be determined based on some assumptions about the estimated useful life of the asset. If the present value of the lease obligation is greater than substantially all the future value of the asset, and if the asset has no alternative use to the lessor at the end of the lease. So if the lease asset meets any of those 5 criteria, it will be classified as a finance lease, which is similar to the current criteria for a capital lease obligation. Now, if the lease doesn't meet any of those criteria, it's going to be classified as an operating lease. Next slide, please. So once a company has analyzed all these factors related to the lease, you'll need to determine the initial lease liability, which will be the present value of all the lease payments not made, discounted using the appropriate discount rate. And then the company will also record a right-of-use asset, which is the lease liability adjusted for any direct costs that are incurred by the lessee, any prepayments of the lease payments, less any lease incentive payments made by the lessor to the lessee. And then these amounts will be recorded on the balance sheet. Next slide, please. So once all that's done, the company's balance sheet will now have these right-of-use assets, which are always non-current assets. It'll be a right-of-use asset related to the finance leases and a right-of-use asset relating to the company's operating leases. You'll also have lease liabilities for both the operating and the finance type leases. You'll have a current portion, which is the portion of the lease liability that's due to be paid within the 12 months from the balance sheet date, and then the non-current portion for each of the finance and operating lease liabilities, which will be just the remaining balance of those liabilities. Next slide, please. And this is just an example of what a balance sheet could potentially look like, both before and after recognizing the lease assets and lease liabilities. As you can see in this example, the balance sheet increased by over $2 million with all the lease assets being non-current, and the liabilities increased by a corresponding amount, broken up between your current and your non-current liabilities. Next slide, please. So under the new lease accounting standard, the expenses for a finance type lease are going to be reported as a combination of interest and amortization expense, and the expenses related to the operating lease are going to be recorded as a single operating lease expense, which will be included in the company's operating expenses. Next slide, please. So here's an example of what a statement of operations could look like, once the new standard is put into effect. As you can see, we broke out the rent expense. That's normally not going to be done, but we just did that for ease of comparison. You can see that here the depreciation and amortization expense increased and the interest expense also increased. However, the company's EBITDA stayed the same under both examples. Now I'm going to turn it over to Amaris so she can talk about how this is going to affect the company's banking relationships.
Thanks, Jeff. So as just mentioned before, if you have any of these types of leases, they will very likely materially impact your balance sheet, which will directly impact any financial covenants that you may have under an existing credit facility with your bank. So next slide. So here I've got a list of just common financial covenants that you'll see on most line of credit packages. And what I'll do is I'll kind of go through a before and after shot of each ratio to show how it changes based off of the new lease standard. Next slide. So first we'll look at the current ratio. As you can see, the current ratio has not changed, or the current assets have not changed from this, but the current liabilities has gone up due to the current portion of the lease liability. In this example, the both before and after is still in compliance with the 1.25 requirement, and so likely no changes needed in this example, but it is still something worth looking at for your company. Next slide. Now for total liabilities to tangible net worth, you'll see that net worth has not changed, but total liabilities has increased a little over $2 million. And so this change, where it would have been in compliance beforehand under the 2.5 ratio requirement, is just now out of compliance at 3.45 times. And so for this situation, you would want to look to modify your covenant requirement to probably 3.5 or 3.75 times to accommodate this change going forward. Next slide. Next example, funded debt to EBITDA, very similar to the debt to worth ratio, where you have an increase in the funded debt number, and due to the current portion and the non-current portion of the lease liability, EBITDA hasn't changed. But once again, in this example, the funded debt to EBITDA is now out of compliance after the lease accounting standard change. And so for this, it probably makes sense to have the covenant modified from 1 times to maybe 2 times. Next slide. For the debt service coverage ratio, this will likely not have as much impact, but it's still worth looking at just in case it may apply to you. The current portion of the lease liability could potentially be included in your debt service portion of the ratio. And so, as you can see, even though it's still in compliance, it was still a pretty dramatic change from what it was beforehand. So no need to make covenant changes here, but definitely worth looking at in case it could materially impact you. The main thing I just want to emphasize is that you should really talk to your banker before these changes go into effect. It's a lot easier to request modifications to your covenant package now before the changes go into effect versus after you've already breached some covenants. So you have a little over about 1.5 years before these changes go into effect. So use this time to talk with your banker, give them kind of a pro forma balance sheet to see where the covenants should be set going forward. And maybe it makes sense to get your covenants modified at your next line of credit renewal. So next, I'll turn it over to Toby to talk about how this may impact your surety bonding.
Great, thanks, Amaris. All right, so anytime there's something that's going to impact your financial statements, it's always recommended to be talking to your surety agent, your surety company. So this obviously would be no different. So next slide. The good news is that there really should be pretty minimal impact to your bonding program. Similar to what Amaris was talking about before about modifying your covenants, the sureties will also look to make adjustments in their analysis as well. So the other thing to think about is that the surety companies, by and large, have been familiar with this coming new accounting standard for probably for the last few years anyway. Most of the surety companies also have exposure to publicly traded companies, which had to adopt this new accounting standard. I believe it was this year, and so the sureties have been aware of it. They've been planning, and they've actually, in I don't know, about half the cases anyway, they've already been making these adjustments in their analysis. And the ones who aren't making the adjustment, at a minimum, are aware of it, and because all of this information is still available in the CPA financial statements in the notes section. So it's not going to be a big shock to the surety underwriting community. So what the sureties are going to do as these changes do take effect, they will simply make the appropriate adjustments to create a good apples to apples year over year comparison. So that's the main thing that the sureties are going to be looking at. So what they're looking at typically, right? So they, if they were comfortable with everything the prior year, and then they make the appropriate adjustments with the lease calculation and create an apples to apples comparison. If there is no real financial change on a year over year basis, then they really won't have any ground to stand on to say, that the underwriting terms should change for the surety program, because there is really no fundamental financial change in the business. There's simply a accounting presentation adjustment. So if for whatever reason you do have an underwriter that creates, that gives you a problem with that, then it's definitely something that should be addressed with your agent, and you probably need to look for another surety company. Unfortunately, there are plenty of them out there, so hopefully that won't be something that you have to do, but if you do, it should not be an issue. Next slide. So on the surety side, there's really only a couple of key ratios I think that would be impacted by this. The debt to equity ratio, which we talked about before in the other slides, is definitely one that will be affected. So the typical debt to equity ratio that's acceptable from a surety perspective, and it varies in some cases, but is 4-to-1 is a good rule of thumb. So if you do have a situation where the new calculation would take you beyond that 4-to-1 ratio that's acceptable, then there is a chance that it could create an issue of some sort. But I think if it's communicated on the front end of what's happening and everybody's on the same page, there really shouldn't be an issue, because the sureties are going to be making those adjustments. So the positive thing to think about from related to debt to equity is another ratio that they actually rely more heavily on, called interest-bearing debt to equity, and this new lease accounting standard is not going to have any impact on that. So that's good news. It's a ratio that's probably there's more emphasis put on that compared to debt to equity, and that ratio is going to be unimpacted. So working capital is a very key ratio that the sureties do look at. They rely pretty heavily on working capital to determine the overall amount of credit that they're willing to extend, that creates your overall bond program, your total bond capacity. So they do rely heavily on it, and there will be an impact to it to a certain extent with the current liability portion of the lease that's going to be applying to the balance sheet. So to the extent that there is a larger current liability that is created that impacts the working capital further, again, it could be something worth discussing on the front end. But in most instances, it really should not be of much of an impact, because the sureties are going to be aware of it and making these adjustments. Just a rule of thumb on the working capital piece for subcontractors, which most of the folks, I guess, listening on this presentation are subcontractors. As a general rule, you want your working capital to be around 7% of your overall surety program. So if you have an aggregate bonding limit of, $10 million, let's say, then you would want to have at least, 700,000 or so in working capital. And so if this adjustment, this new accounting presentation, will impact that specific ratio to a large extent and really drive down that percentage, then it is something that you probably want to discuss. But in most instances, I don't feel like the impact is going to be real meaningful. Next slide. Okay, so some exceptions that might be in play. If you're a startup company, this is going to be a challenge anyway from a bonding perspective. Startup companies generally have a hard time getting bonding, but in the case of a startup company, there is no historical financial information to do a year-over-year and apples-to-apples comparison. And so that could present some challenges. If you already have a weaker balance sheet relative to your bond program, then some of these ratios, some of the impact on some of these ratios, could be more detrimental than others. If you have some sort of other financial deterioration on a year-over-year basis, in addition to now also having to have the adopt this lease standard, that could also impact it. And if there is if you do happen to have an abnormally large amount of leases, and it impacts your balance sheet to a larger extent than most companies, there always are going to be outliers, exceptions to the rule. So something to think about. You talk to your accountant and look at what the impact is going to be to your overall liabilities. And if your total liabilities are going to increase beyond, say, 15%, you might be starting to get to a point where that might be viewed as a significant amount of additional new liabilities. And you might want to, have the discussions with your agent and your surety company. Also, if there are any meaningful changes to your bank line of credit as a result of the new standard, if it impacts your bank covenants to a certain extent where you have to decrease your bank line of credit limit. The sureties obviously have a lot of emphasis on the bank line of credit and how much availability you have under that line of credit. And so if that is impacted in any way or going to be impacted in any way, it's definitely something that should be addressed with your surety to make sure everybody is comfortable and aware of that situation. Next slide. So finally, just again, reinforcing the communication with your agent and your surety company. It's always a great idea to have good frequent communication with your surety agent. The more you're communicating with them, the more they're going to be able to help you and your business. And also, I would not wait around until you need a bond to have these conversations. The sooner you have these types of conversations with your agent, the better. The surety companies do not like surprises whatsoever. That's really when you can get kind of in a bad spot with your bonding, is when you surprise your surety company at the last minute right before you need a bond. That's not going to be generally a positive outcome for anybody. And just to reiterate, there are 30 plus surety companies out there that your agent likely has access to. So with an appropriate amount of time, if any of these issues do arise, there should be another surety company for you to get partnered up with, with the appropriate amount of time. So that's all of my slides. So I'll turn it back over to Brianna for some Q&A.
Great, thank you, Jeff, Toby, and Amaris. And so now if you have any questions, you can either raise your hand and I can unmute you to ask it, or you can type your question in the chat. I don't have any questions in the chat right now. So if anybody has questions, we'll give you a minute or two here to raise your hand or type in a question. And I am not see any, so you guys must have done a fantastic job of covering everything that needed to be covered. Okay, so no raised hands, no questions in the chat. So with that, I'd like to thank the three of you guys for taking your time today to explain this information. And for those that are on here, we will send out an email with a recording of this. If you missed any of it, you can go back. You also have access to the PowerPoint that they did. So with that, I want to thank everybody for coming today, and we will end the session.